In this example problem, we're going to be selling inventory, but we're going to be doing so on consignment. And when you sell inventory on consignment, you don't have that inventory in your own retail location. What you do is you send that inventory to another party who sells it on your behalf. That other party isn't buying it from you at the time. So it's not like you're a manufacturer selling to Target or something along the lines. It's still your inventory. You still have possession of it. They're just holding on to it for you and selling it on your behalf. So what is the consignor's end of this thing? Well, consignors make their money by charging commission. So every piece of inventory that they sell on your behalf, they get a cut of. It's still, again, your inventory. You haven't actually sold it to this other party. The other party just physically has possession of it and is making transactions with the public on your behalf. And it's a great way for companies that don't want to run a retail storefront to get their goods into some retail place that people can go and buy it without having to outlay the overhead for a building to sell out of and all of the overhead costs, the utilities, salaries, etc., that go with it. So in this example, we're going to be Clone Clubs Incorporated, and we are making some golf clubs. We're going to send them to Courteous Consignment, who are going to sell them on our behalf on consignment. The information pertains right here. So we spent $35,750 on these clubs. When you consign to another party, you get to dictate your expected retail value. And our retail value of these clubs is we want them to be sold for $55,000. And Courteous's take of this is they're going to keep 16% of whatever they sell these for is their profit, is their commission. So let's do this first from the side of Clone. And Clone is the company that made the golf clubs that sent them off to some other party to be sold on their behalf. The first thing we have is record the journal entry to put this inventory on consignment with Courteous Consignment. So this is happening on January 6th. So let's throw that in there. Excel wants it to be in 2025, so I guess that's fine. The way that I name this account is always consignment inventory. I have seen it called inventory on consignment, which is just the same thing, just different verbiage because people can't agree on what they're going to call things. And since we don't have possession of it, it's not a finished good in our possession that we're capable of selling at the time, which means we need to take it out of our inventory. So I'm going to take this out of finished goods inventory. I'm doing this assuming that we are the manufacturer, so we would have finished goods inventory. If we were a retailer, and we didn't make the stuff ourselves, it would be carried on our books as merchandise inventory. So when we consign it to someone else, we have to take it out of merchandise inventory. And then we're going to transfer this at the cost that we are carrying it at. Well, what value do companies carry their inventory at? It's cost basis, what they paid to acquire it, or in this case, because we're a manufacturer, what we paid to manufacture it. So we'd be carrying those golf clubs at $35,750. We have to put that in consignment inventory and take it out of finished goods inventory. And here we consigned inventory to Courteous Consignment. The next thing that will happen over here is that Courteous sold the whole batch of clubs that we sent them to Rick's Sporting Good on our behalf. They did that. We have no formal notification that it has been sold at this point in time. Courteous knows that they've sold it. They've not yet contacted us, in this instance, Clone, which means our financial position at this point in time would have not changed. So there's no entry that Clone would be required to record. But on the day afterwards, when Courteous Consignment calls up Clone and they say, hey, we just sold all of those golf clubs to Rick's Sporting Goods. Well, now Clone has documentation that these goods, which again are still legally theirs, have been sold. And because it's their inventory that's getting sold, it's now time for them to record some revenue. So we're recording revenue. Let's start at the bottom. We need to credit to sales revenue to increase our revenue account by the amount that we sold it for. And we are selling these at, well, I should say the consignor sold it on our behalf at retail value, which is given in the information as $55,000. So we need a $55,000 credit. But we're not getting $55,000 in cash right now. Why? Because the consignor, Courteous Consignment, is charging us a commission of 16%. So we're going to need two debits. One of them is for the amount of money that Courteous now owes us. And it's a receivable account, but it's got the fancy name of due from consignee. That is the amount of money that we're going to receive from Courteous Consignment because they sold inventory on our behalf. We don't have it yet, so we need to put that receivable on the books, but we are going to get it. But we don't get the full 55,000. They're keeping a part for themselves, their sales commission, which we're going to record on our books as clone as sales commission expense. So we got two debits. How do I figure out what they're for? Well, what's the sales commission expense? The full sale value of this was $55,000, but Courteous is keeping 16%. So 55,000 right there times the 16% commission charge. And I put it in the wrong cell, good times. Means, let me do that one more time, 55,000 times the 16% means that Courteous is going to keep $8,800 for themselves. So what would our take be? Well, debits have to equal credits out of the $55,000 this was sold for. If Courteous is keeping 8,800, that means that they now owe us officially the other 46,200. You can always check your math by taking the full selling price that you have and multiplying it by the complement of the commission expense. So in other words, 100% minus 16%, or if you will, 84%. We get the other 84%, and 84% of 55,000 is the 46,200. And here we recorded sale of consigned inventory. And the matching principle between the revenue recognition principle and the expense recognition principle says that when you record the sale of inventory that you have, it's also the same point in time that you have to record the expense because the expenses have to be recorded in the period that match the revenues. So we're going to go over here on 129 and record a second entry that you've seen a variant of a million times at this point in time. We get to record our cost of goods sold. Finally get to record the expense of that inventory. And we were carrying that inventory on our books for 35,750 before we consigned it to Courteous Consignment, but that is still its cost basis. So we need to record COGS equal to the manufacturing cost to make that. And that inventory, we can't take out of finished goods because we already took it out over here and put it in consignment. And it's no longer there. It's no longer being held on consignment by Courteous Consignment. We got to take it out of consignment inventory, and it's going to be a credit for 35,750. And here we recorded COGS on sale. So consignment has been increasing in popularity. It's just really, really expensive to run storefronts nowadays. At the same time, there's a huge market of people still, way more than you would think, that aren't the biggest fans of buying digitally, and especially if you're in an area where you have product that it's something that people usually refrain from buying if they haven't yet, seen it or touched it with their hands. And clothing is the best example that I can think of in this case. Like there's a lot of people that don't like to buy clothing without trying it on first. So if you had a seamstress that was making clothing in this case, and they don't want to have their own storefront, it makes a good sense for them to consign it. So I'm going to flip this perspective now. Let's do courteous consignments books because some of you might account freelance for a company that does a significant amount of consignment. What would courteous look like? Record the journal entry to put clones inventory on consignment with courteous consignment. What does courteous have to do? Answer to that is absolutely nothing. The consignor never puts inventory on their books when it happens because they don't physically own that inventory. Yes, they would have a log somewhere. Somebody would open up a spreadsheet that's like, this is what we're holding in consignment to so and so. But as far as their actual financial position goes, it's not their inventory. They can't put it on their books like they own it because they don't own it. When you consign it, the party that consigned it in the first place is always the legal owner of it. What about on January 28th when Courteous makes this sale to Rick's Sporting Goods? Well, at this point, they know about this and they sold it to Rick's Sporting Goods. So Courteous would be getting some cash on the sale. And I can tell you right now, since that inventory in this example was sold at retail price right up here, they would be getting $55,000 in cash from Rick's Sporting Goods. But they don't get to keep all of that cash. They have it all for right now, but they're going to have to send the portion that's not their commission back over to Clone Golf. So we did make a little bit of money if we're courteous consignment, a little bit of revenue, if you will, which we're going to call commission revenue. And that we already calculated. Courteous's commission was $8,800. So where's the rest? What's the other credit we need here? Well, let me go and figure out what makes my debits equal my credits. And it's 46,200, which is exactly the same amount we recorded up here on Clone Golf's books that was due to them from Courteous. Well, if it's due to Clone, then in this case, Courteous is now obligated to pay it to them. They're liable, if you will, to pay it for them. So they need a payable account on here. And once again, we'll have some fancy names. This is called to, excuse me, I wrote from, due to consignor. And that is a liability account going up. It is accounts payable, just with a fancier name. And I typoed it. The G comes before the N, due to consignor. There we go. And here we recorded sale of consigned inventory. And then the next day, we notified Clones Clubs because, again, we're courteous consignment now. What do we have to do to our books? Nothing. We already recorded our revenue. We don't have to expense this inventory because we never put it on the books in the first place, which means there's no entry required to record the revenues of this sale. We're not the ones recording the sales revenue. It wasn't our inventory to begin with. And since it wasn't our inventory to begin with, we don't have any inventory to adjust on our books or other expense to record. So what I'm getting at here is when you're the consignor, the inventory doesn't go on your books. It's not yours. You don't legally own it. The only entry that you ever will have to record if you're selling on somebody else's behalf is the actual sales, to put the cash you received on the books, to record the revenue that's your take from your commission, and to put the liability in the books so you know that this amount of cash has to be sent to your other party at some point in the future.